Hello everyone, I'm Nikhil Mishra from Setu Capital and we'll be starting our quarter 3 related discussion. We'll look into a company called Eris Lifesciences. So it is the manufacturer of cardiac and diabetic related medicines and mainly does business in the domestic market. So if we look into the performance of this company, and if I want to summarize it in just two lines, I would simply say it is increasing top line and decreasing margins. Before moving ahead, there is a disclaimer that none of the discussion should be construed as investment advice, and it is purely for in educational purposes. So before moving ahead, let me give you a brief background about this company, why this company is a bit interesting, and why we are discussing it even. So this company was mainly started by Mr. Amit Bakshi, who who and his major colleagues used to work in other pharmaceutical companies, and it operates into the high-growing domestic diabetic and cardiac related portfolio. Now, this company also has a very high profit margins, which is generally not seen in other segments of generic pharma manufacturing for which Indian companies are mainly known overseas. But this company is mainly into the branded formulation manufacturing, and the brands do take a lot of gestation period. So which leads to a gestation period in which there are losses and there the brand develops and then it starts making profits individually. So for the financial performance, what you will find is that the revenues or top line has grown around by 27%. The gross profit margin has remained more or less same. EBITDA margin has declined by around 4,200 basis points or 4.2%, while the PBT margins have declined substantially. Now let me give you a brief background. What has happened is that this company has, because of surplus cash available in its books, it has started acquiring other um, domestic related portfolios from other companies, which it feels is not being operated properly or is not into the core segments of other companies, and that's why they are willing to sell it. They buy companies which are operating less efficiently, and they try to turn it around and bring it to high profit margins. So in order to do that, they have taken up debt, and there is a lot of depreciation charges which is being incurred into the P&L, and that's why after the EBITDA means interest and depreciation is affecting the profit margins. Now, in itself, it is good because these changes which it is making to its own in its own acquired products are going to be are going to help benefit it sometimes in the future, and is better for the company because the top line is growing. But the whole thing takes time, and that is what is happening to this company. Now, revenues are growing are growing because of the acquisitions which it is doing. The acquired brands have lower margins. These Eris has a very good medical representative MR strength, and they have one of the highest operating MR performance. So they expect that these acquired brands will be able to perform better in the future. Lower margins are because of the depreciation and finance cost which are impacting the profitability of the company. Now, what has happened to the stock? See, stock prices are slave to earnings. So if the profits are not going to increase, the stock prices generally don't move. If we leave aside the factor of re-rating or derating. So in the past 1 year, the stock price has is down around 12%. At present, this company trades at 22 times earnings. Previously, it used to trade at higher profit margin. Higher price to earning multiples. Now, this is the scenario for last 1 year. If we look into the past 5 years, 5.5 years since the time at which this company came into IPO, more or less the stock price is flat. What does this indicate? Just like it happens with many IPOs, this company also came at higher valuations. And just like other IPOs is available at relatively lower price. Most IPOs generally trade at lower price within 8 to 10 months from their IPO date. So the question comes that why is it that this company is still interesting? The reason being is that if you look into its the profit margins, you'll find that there are very few companies which have a profit margin of north of 25% and are growing at in high teens. And the 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 cash which it generates from its own margins, it is able to redeploy by acquiring, and it has had a past history of of inorganic expansions, and it has been able to improve their performance. Now, there are few other changes which has happened. Recently, they have inducted a new person to run the operations of the to run the business, to head the business, Mr. Krishna Kumar, who was a consultant in McKinsey earlier and was working in the pharma related division itself. So we are seeing a lot of inorganic opportunities after his induction, and feel that these changes which they are trying to make, and they're mainly focused in cardio and diabeto portfolios. Now they have started acquiring and building a suite of products in dermatology as well. They had recently acquired Oaknet, and now they have done acquisition of 9 brands of Glenmark Pharmaceuticals, the pharmaceutical company of Glen Saldanha, who is mainly which is mainly focused into the export of generic products to other countries. They acquired this company at a price to sales of around 4.5 times. The company had a turnover of around 87 crore, and they have paid around 340 crore, which I feel is which I feel is seems to be on the higher side. Just optically looking at it, the profit figures are not known and were not disclosed as well, so we can't make a fair judgment of what it is. But given the past history of this company and its acquisition, there must be something interesting about this whole 9 brands which they are acquiring, and that too at such high valuations. We are just giving a benefit of doubt to this company's management because of their own past track record. In the past 3 years, this company, the 9 brands, have been flat, and their sales have not grown at all. The As per the Mr. Krishnan Kumar, they these derma brands were not into the core focus area of Glenmark, and they expect to improve it going ahead. So in FY23, what are the guidance which they have given? They have given a guidance of around 25% for FY23, and an EBITDA growth of around 15%. Looking from the not so looking looking from the outside, it might seem to be a good performance, but overall, if you look closely, there are going to be depreciation and interest impact, which will impact the profit growth. And as per my calculation, the profit growth seems to be coming subdued and may remain in this single digits at max. So what will happen is that since stock prices generally, if we leave aside the something happens extraordinary, or there is some extraordinary development which will lead to re-rating of this company, more or less the profit growth will remain flat, and that's why the stock prices will also remain flat. And that is what we are seeing in the past 1 year performance. So this brings us to the end of this presentation. I hope you liked my analysis. And in case for more stock related discussions, please do subscribe to my channel. It will mainly be about fundamental stock discussions. In case any some of you wants to take the help in your wealth creation journey, do contact us. We'll be happy to help you. Till then, thank you. Thank you very much.